because a lot of clients think about their equity holdings as being the market, right? And they compare those strategies to the S&P 500 specifically. And actually, in a year like this year, it's actually been good for a diversified portfolio because you're actually seeing a little bit of a broadening within the market, and you're seeing some of these other indexes or indices start to outperform the S&P 500 or at least catch up to the S&P 500. Whereas the last couple of years, what we've experienced or where we've had a problem in our industry is trying to explain to clients that have a diversified portfolio that maybe their entire portfolio isn't actually keeping up with the S&P 500, because that's been the only index, quite frankly, over the last few years that's really performed very, very well. And so this is where it always leads into the broader based discussion of why we still build diversified portfolios and why we're not just strictly investing in the S&P 500.
Okay, so we have multiple sectors inside of a portfolio so that it doesn't really matter when it happens. The portfolio either doesn't take the hit that the S&P 500 does, or it's positioned to actually do well in not necessarily a good market. So that's the first real big part of diversification is sectors.
Welcome back. We've got another edition here of the Retirement Planning Happy Hour. Eric Douglas, Chris Vaughn here with Family Wealth Planning, and we've got a pretty good treat here. Well, first let's go to the topic that we're going to be touching upon today. And we're going to take the word diversification and go over all kinds of different types of diversification that are very important when we are doing or constructing a portfolio, or I should say even more specifically when we're constructing a retirement plan for a client, because we're not only going to be talking about portfolio diversification today, although we will be leading off with that. So joining us in that topic today, we've got a bottle of Elijah Craig Barrel Proof. And so I'll let you maybe give your little spiel on the bottle of bourbon that we're going to be tasting this morning, and then we'll go from there.
All right. So I don't know if you've ever had this before, Eric, but the Barrel Proof is one of my favorites. I'm an Elijah Craig fan. I love this stuff. It was interesting that we selected diversification to talk about because they've kind of done this here. So up until I believe 2022, please don't quote me, I may be wrong on that. They would release this 3 times a year, and it was always a 12-year-old bourbon. So it's a single barrel, so that means everything in that bottle came out of the same barrel. So in theory, the next release is going to taste different because it comes out of a different barrel, and there's all kinds of interaction. The 12-year part, if you know anything about bourbon, most people will tell you that 12 years is that magical point where you get the complexities have developed enough, but after 12 years, it starts going more towards an oak flavor, right? So a lot of people are big fans of the 12-year. Well, they changed that. Like I said, I think it was 2022. And they actually started getting away from the 12-year, but they still stay in that window. So they do 3 releases a year. Each one is different. Once it's gone, it's gone. There's a thing on there. This is the A125. So here's what that means. The A is the first release of the year. The 1 is the month in which it was released, and then 25 being 2025. So this was the first release this year. As we are recording this, it is Friday the 13th of June in 2025. So the next one is typically done in May. So we expect to see that on the shelf at any time. So that'll be B525. And then in September is usually when they do the third one. I will tell you they are all fantastic in different ways, and usually the third one of the year is the best one. This one is 10 years and 7 months old, so it should have some pretty good complexity to it, and this is the lowest proof that I can remember seeing of the Elijah Craig Barrel Proofs, and it's 118.2. These are usually 125 to 130. Mm-hmm.
Pretty stout.
Some of them been over that, so this gets way up there in the proof. So have a taste of that, see what you think. Tastes like cinnamon to me, and I mean that in a good way. That's what it tastes like. It's just heavy cinnamon and honey. And I
was going to say I taste a lot more honey than cinnamon, but yeah. But we'll come back to that, and we'll give more of our endorsements here at the end. Right. But let's start talking about diversification. Okay. And so the idea came up, once again, as pretty much all of our topics do, come from client conversations that we have. throughout the course of our meetings during any given week. And I ended up talking a lot about diversification because every now and then, and we fall into this trap as well sometimes as advisors, because everyone wants to know how we're doing against what?
The S&P 500.
Because for some reason, that's the only one that's the only index that anyone cares about, right?
Yeah.
And that's, probably for good reason, because that's the one that gets all the publicity on Fox Business and CNBC and all these other business stations. Whenever anyone talks about the quote-unquote market, they're usually referring to the S&P 500. Yep, that's right. And not to say that doesn't, that's not an important index to review, but it by no means is representative of the stock market as a whole. So I always laugh when anyone talks about the market and they're referring to the S&P 500, because it's actually a very, very limited view of the quote-unquote market as a whole.
So why don't you define exactly what the S&P 500 is? Because I think most people don't really know.
Correct, yeah. So the S&P 500 in and of itself is 500 biggest U.S. domestic-based companies.
Key thing, U.S.-based.
Exactly.
There's no, you think about, there's some companies that are big, do a lot of business in the United States, but they're not domestically based. The first one that pops into my mind, especially here in Kentucky, Toyota. Mm-hmm. That's not a U.S.-based company, so that's not what the S&P 500 is referring to, even though it is a massive company.
Mm-hmm. And one of the biggest employers in Kentucky.
Yeah.
So you're taking the 500 biggest domestically based companies, and then what you do from there is it's not only just the 500 biggest companies. So this would make it basically a large cap equity strategy or large cap equity index, if you will. But from there, it even goes one step further and it becomes what's called market capped or market capitalization. So essentially what it does is it takes all 500 of those companies, and their weighting within the S&P 500 index is based upon how big or their market capitalization is, how big those companies are in essence. And so whenever we talk about the Magnificent Seven, we talk about the Magnificent Seven strictly because of the outsized weighting that those specific 7 stocks have relative to the rest of the S&P 500 index. So much so that the top 7, and I need to get an updated number, but last time I checked, it was still a little bit under. It had gotten over 40%. I think it's a little bit below that now, with some of the
the ebbs and flows.
Well, the ebbs and flows of the market that we've had here in 2025. However, it's hovering right around 40%. So
7 stocks are 40% of the 500 biggest companies.
Exactly.
That should tell you something right
and
there.
493 stocks make up 60% of the remaining index. So the S&P 500 index is a broad-based U.S. index. It's a large cap index. And yes, it is fairly representative of, let's call it, big business or corporate America, if you will. However, it is not entirely representative at all of the market as a whole, or especially Main Street. And this is what we mean by, a lot of times everyone likes to refer or say things like the market is not the economy. And this is what we mean, because this is really where you draw a line in the sand between corporate America and Wall Street, if you will, and Main Street. And so typically when you're looking for things that are going to be far more indicative of how things are doing in Main Street America, you're going to be looking at things like small cap companies. Right? Smaller capitalization, meaning they're smaller companies relative to their larger counterparts, right? So all that to say,
Can you tell Eric really enjoys this part of it?
Yeah. So all that to say, when we talk about, how we're doing versus the market, I always like to ask clients, what market are you referring to?
Which market are you talking about? Right.
and usually you just get, kind of a, deer in the headlights. Exactly. You get kind of a blank stare like, I don't know, just the market, because the only thing that most people know about the market is usually the S&P 500, maybe the Dow Jones, which that's even less indicative of the market as a whole.
That's only 30.
Exactly.
Companies.
So that's a very, very, very limited view of the market as a whole. So this is where we need to get into a conversation about portfolio diversification, because a lot of clients think about, their equity holdings as being the market, and they compare those strategies to the S&P 500 specifically. And actually, in a year like this year, it's actually been good for a diversified portfolio, because you're actually seeing a little bit of a broadening within the market, and you're seeing some of these other indexes or indices start to outperform the S&P 500, or at least catch up to the S&P 500. Whereas the last couple of years, what we've experienced, or where we've had a problem in our industry, is trying to explain to clients that have a diversified portfolio that maybe their entire portfolio isn't actually keeping up with the S&P 500, because that's been the biggest and best performing
and it's
index.
The one they're talking about on the news, right?
And it is the only index, quite frankly, over the last few years that's really performed very, very well. And so this is where it always leads into a broader based discussion of why we still build diversified portfolios and why we're not just strictly investing in the S&P 500.
Well, okay, so here's a good one. Here's why you stick to a diversified portfolio even when one sector is doing really well. And we'll talk about this quilt chart that we've got in front of us, and we'll get that thrown up on the screen for the people that are watching. We don't know when 2022 is going to happen. We don't know when March and April of 2025 is going to happen. We just know it is going to happen. And we did a podcast on that a couple of months ago about the catalysts that cause these things to happen, but we knew they were there. The reason that you have a diversified portfolio is because we don't know when that's going to happen. We just know that it will. So we need to be prepared for it ahead of time. So let's talk about this quilt chart for a minute. So if you can see this, it looks a little bit like a quilt that your grandmother might have sewn, and that's why they call it this. So the way that these are divided up, if we can get this one thrown up there where everybody can see it, is you're going to have columns of a year, right? So across the top of this one we're looking at, this is 2004 through 2023, so a 20-year window. And each color represents a segment of an investment. So for example, and I got to put my glasses on because unlike Eric, my vision's shot.
Just say you're old, Chris.
I'm old, I get it, I admit it. So, you know, if you look back at 2004, the very top thing, meaning it's the best performing sector that year, was, on this chart, real estate. Real estate was up 37.96% that year. Now, here's what's interesting about that, and this is where it's kind of neat when you study a quilt chart and you're building a diversified portfolio. If you look at the things that are up at the top, so the first 3 years, the two top performers, and they alternate, are real estate and emerging market equities. Now, if you don't know what that means, we used to call those third world countries, right? Those are much, much higher risk things. So when you do well, you do really well. And when you don't do well, it's usually really bad.
Basically far less developed economies.
Yes, exactly right. Therein lies the point. Now, in 2007, emerging market was number one, but real estate was last on this chart. So the one at the top is the best performer of the year. The one at the bottom is the worst. Now, that doesn't mean that the best performer is positive, and it doesn't mean that the worst performer is negative. Those happen. But real estate, for example, emerging markets, and there's other categories in here, they tend to be at the top or they tend to be at the bottom. They don't spend a lot of time in the middle. Okay? And when you do see them in the middle, everything is up or everything is down that year. So when you're talking about diversification, we don't know when the next 2001 or 2008 or 2018 or 2022, we can keep going on. We don't know exactly when those are going to happen. So we have multiple sectors inside of a portfolio so that it doesn't really matter when it happens. The portfolio either doesn't take the hit that the S&P 500 does, or it's positioned to actually do well in not necessarily a good market. So that's the first real big part of diversification is sectors.
Well, it goes to being able to diversify the sectors that you're invested in, but really it's a risk management
Correct.
play.
That's right.
And so the idea, and we've talked a lot about the 60-40 portfolio over the years, if you've listened to any of our content over the last few years, and how the idea or how the traditional 60-40 portfolio is dead, but the idea of a 60-40 portfolio is still very much alive,
Sure.
Meaning you want to diversify your portfolio at the end of the day. And the reason why you do that is because you don't want to put all of your eggs in one basket. It's one thing, and I have this conversation with clients all the time when they walk into the door. Switching off from an accumulation mindset to an income mindset. basically drawing down your investments. It's a different game that you have to play. The game that you're playing during the accumulation phase is you're trying to make as much money as you can. You're trying to save as much money as you can. And yes, you are probably going to be shooting for the stars, so to speak, in regards to your performance. You want those big pops. You want to take a little bit more risk because you want a little bit more of the reward, because you have a much longer time frame to invest and recover from any losses that you might experience. So typically you can afford to take the risk, because the risk in your retirement accounts is, you're not going to have to exactly. You're not going to have to experience any kind of downfalls for probably several decades, and at least you have several decades to recover from any risks that you did take and maybe you did lose on. When you walk into our door and you are looking to retire in the next few years, the game's been played. The cake has been baked. Whatever analogy that you want to use.
The cake is baked. I like that one.
The cake is baked. You've already played the game. The game has been won. Okay? If you continue to play the game the way you have been, okay, there's a much greater chance of you losing. There's a reason why, if you remember, and this is an old reference right here. I just pulled this one out of the top of my head. But Dean Smith back in the 80s, what kind of ball was he known for playing in the 70s and 80s? The four corners, right? Or was this IU, Bob Knight?
Wow, you took me back to my childhood.
Yeah.
Wow. Okay, four corners. I remember Denny Crum playing four corners.
Yeah, and I
don't know if Dean did it or not, but I apologize to North Carolina fans. I just don't remember.
Regardless, but anyway, the idea behind a four corners offense was, okay, you get a lead in a basketball game, you move to a four corners offense, and you're basically just passing the ball around, and you're trying to run clock.
Them from getting to it. That's
you're
right.
trying to run. You're trying to run the clock.
Clock existed.
And so the game, your strategy within that game becomes significantly different when you have a lead. Okay, when you're trying to play the clock out at the end of a game, you're trying not to lose a lead at that point. You're not necessarily trying to win because you've already won. You're trying to keep what you have. You're trying to maintain the lead that you've already got. You can take that same analogy and apply it to retirement. When you come to retire, the cake has been baked. You've already won the game. All those analogies, right? There's not really much that you're going to do in retirement to dramatically affect one way or the other your overall lifestyle or the value of your portfolio,
right?
Other than general market performance. So in order to get outsized market performance, you have to take what? Outsized risk.
Risks. Yep.
And there's far greater risk in a big downfall, or a big decline, drawdown within your portfolio in retirement than there is any reward of having some major pop.
Let's talk Warren Buffett for a second. What's rule number one? Okay, Warren Buffett, greatest investor of all time. I mean, nobody argues that. What's rule number one? Don't lose money. That's the key thing during retirement, is don't have the negative drawdowns or have extremely limited amounts of them. That's the difference between the accumulation phase, where you're trying to get that performance, and what we call the distribution phase, where you're actually using the savings that you've got as part of your income, or however you want to go about using it. You don't lose money. And by the way, if you're not familiar with Warren Buffett, rule number one is don't lose money, and rule number two is what?
See rule number one.
See rule number one. Right? Do not forget rule number one. So that is the biggest issue when you're building out a diversified portfolio for retirement, is positioning the money that you're going to be using in the next 10, 15 years, right? Where there's no risk of losing. That's really the key thing. You got to take that off the table. So that's kind of the diversification mindset is, okay, go back to your first point. People come in and they say, I'm not keeping up with the market, and they're looking at the S&P 500. If you are in retirement and you are keeping up with the market, I would bet a fair sum of money that you are so overly risked for your situation. And all it takes is one downturn at the wrong time, and you could be in big trouble.
Ultimately, in retirement, you should not terribly care too much what the S&P 500 does on a day-to-day basis.
Yeah, that's right.
You shouldn't care too terribly much what any index does on a day-to-day basis, because you should be diversified, right? And you should have access, or you should have investments across all of the different major indices and other types of traditional investments, because you should not have all of your eggs in one basket.
Right.
You should generally care, of course, right? But you should not be in a position where any major drawdown in any specific index is going to dramatically affect your opportunities or your chances to have a successful retirement. Because you need to make sure that your risk is managed to the point that you're not taking any too dramatic risk in one single sector of the economy.
All right, so I'm going to transition just a little bit. When the markets went down here a few months ago, and they plunged pretty hard there on Liberation Day, we call it. And
Tariff stuff.
Yep. And we did a podcast on that.
Sure.
And we kind of toot our own horn a little bit. How many times did our phone ring with a client going, holy cow, what's going on with my portfolio?
Very few.
I didn't get a single one. If we got one, I'm unaware of it. Now, that's not because we've got some magical thing that we do. That's not what it was. It was that our clients who are already in retirement were not affected by that with the money that they're currently receiving. Why? Because it's in a different pool. It's not in that S&P 500 index. It's not subjected to the market risks. So they're not worried about whether their paycheck's going to show up this month or not because the market went down, right? So let's go into a slightly different form of diversification, and let's talk about strategic and tactical and alternative parts of the portfolio. So when we talk about strategic, and just remember what strategic means, that's something that you're looking at long term, right? So the way that we do it, for example, we have a portfolio, we call it the risk on, but it's an all equity portfolio, and it's designed to be used for monies that are not going to be used for at least 15 years, right? We know the market's going to go down. We know it's going to go up. It's going to do both. Over a 15-year period of time, there is no negative in the markets. There's no historical evidence of a 10-year negative. So that's our strategic part. That's our long term. And then there's our tactical type. Now the tactical, that's where you got to move, you got to shift and punch a little bit. That's kind of the art of what we do when it comes to income planning and retirement. This is where you start saying, okay, I need something that has no market risk. So it can't be that all equity portfolio because I'm going to use it in, say, 2 years, right? What is available right now that can take the risk off but still be liquid in 2 years, right? There's lots of things out there, by the way.
And get more yield.
And get as much yield or return as I possibly can than what cash would do. Because we've talked about this. Cash is a fantastic thing to have, but it's also the only investment that's a guaranteed loser because it loses value due to inflation. So cash is certainly going to be part of that tactical strategy. This is where, some other things come in where, government debt, quite frankly, we talk about how horrible the government debt is. And, we've had discussions about our politicians and our opinions of them. I won't go into that right now, but if you really want to have some fun, come hang out in the office on a Friday afternoon when we have a drink and we sit here and start talking politics.
And the cameras go off.
And the cameras are not on right. Government debt is actually a really, really good short-term part of a portfolio because we don't have the risk, right? We do have the liquidity. We know exactly what rates of return we're going to get, things like that. And then that third part, and I use the word alternatives, I want to stress this is not the infamous alternative investment or an alt that we loathe because of liquidity problems. There's a lot of issues with that. It's simply things that are outside the normal markets. For example, this is where some types of annuity can play in because that is an insurance against loss. That's what it's supposed to be. This is where you might get into things like structured notes, which we could talk for 6 hours about that. And trust me, you'd be bored out of your mind if you listened to us. This is where other types of investments can be plugged in order to build out that portfolio in such a way that you are no longer worried about whether the income is going to be there or not. This is where it's different than just the accumulation phase. And I love what you always say, Eric. If you want to build up wealth, save it, invest it, and leave it alone. Right? It's not like that when you get into this phase. So that's a totally different type of diversification. It's a diversification of a different strategy.
It's interesting, and I was going to say real estate also is another alternative type of investment as well. People don't necessarily think of it as an alternative investment, but anything that's kind of outside the norm of a traditional stock or bond portfolio is in our world considered an investment,
an alternative,
an alternative investment. Yeah. So, train of thought. Where was I going before I mentioned the real estate?
I was going to stop, and you're reaching for the bottle, so you're kind of thinking the same thing I am. Maybe we should sit here and talk about this bourbon for a minute, because then I think we want to talk about tax diversification, which is a passion point for both of us. So, first of all, what do you think? You said you didn't taste as much cinnamon as I do. You were tasting more honey.
I taste a lot of honey.
Okay.
There's not much of a chew, if you will. There's not much of an aftertaste, but it kind
for 118 proof, this does not have the burn that you might expect.
It coats your throat, but it's not a burn.
Yeah. I did, if you noticed, I put 2 drops when I still had a pretty fair amount of bourbon in there. 2 very meticulous drops, and it did change it. The cinnamon has become more of a clove, baking spice type flavors. The honey is even more pronounced than what it was.
That's a very specific taste.
Yeah, I'm picking up some very specific flavors. And this is where I said at the beginning, that 12-year little window, that's when you get the most complexity, the most flavors are there. And we could do a master class. I asked a guy named Steve Camisa one time, who is famous in the bourbon world. I said, Steve, how do you taste different things? And he said, man, it's unique. Your palate is different than mine. What do you taste? What do you want to taste? And keep in mind, there's a power of suggestion in here. If I said, you know what, I taste wet rocks, there's a possibility that you might actually start tasting wet rocks, which to me, that's what Scotch tastes like. So there's a subliminal part to it. But those are the things that I get when I cut it a little bit. I'm going to cut it again while I've still got a fair amount in there, just to see what changes. And then while we're doing that, let's talk about taxes. Everybody's favorite subject.
Fun. Well, so let's talk not necessarily about taxes, but tax diversification, right? Because we talked a lot about portfolio diversification and why we want to build diversified portfolios, of course. And it's worth noting that the diversity in portfolios doesn't necessarily. You talked about the strategic, right, and the tactical. You build diversity within each one of those sectors of your portfolio as well. So it's important to remember we have diversification within every sector, or within every section of a portfolio. So, in years like 2022, where the market was down.
There's that word again.
The market, I'm using air quotes if you're listening on podcast, but where the market was down significantly, well, our clients loved us because we have built a diversified portfolio that wasn't totally exposed to the market or exposed to different parts of the market, including some of those alternative types of investments. They weren't down nearly as much as the market. Now, in a year like 2023 and 2024, where the S&P 500 is the only thing that's up significantly, it's going to look like underperformance. And I hate that term. I hate that term, underperformance, because the things in your portfolio are actually doing quite well. The small cap funds that we use actually overperform the small cap indexes or indices, right? So we have some of the best small cap funds.
I want to stop you for a second. I want to interject something here that I think is important when it comes to the amount of risk that you take. You were talking about, our clients loved us in 2022 because we didn't take the hit, because we were a little bit more tactical. We underperformed, there's those air quotes, in 23 and 24 because we didn't lean into the Magnificent Seven as much. If you are...
Not that we didn't have any exposure.
We were exposed to it, but maybe not heavily exposed to it.
But when that's the only thing that you see on CNBC.
Yeah. Correct, because they're not dealing with a portfolio, they're dealing with an index. That's what they report on, because they can't do a portfolio. The one thing that I wanted to point out here is when you are in your retirement years, you should never be asking the questions, how am I doing compared to the market, as you said a while ago? You should be taking the absolute minimal amount of investment risk that is possible and still get to your goals, right? Why would you take risk that is not necessary? That, in my opinion, not very humble opinion on this subject, is foolish. That's I apologize.
Well, coming back to I told you I lost my train of thought earlier when we started talking about bourbon. Happens, right? So what I was going to say, though, is the lack of diversification is a great way to accumulate wealth. Mm-hmm. It's a very great way to accumulate massive amounts of wealth. Take, for example, Bill Gates, right?
Sure. Yeah, great example.
Bill Gates, all of his wealth was tied up into Microsoft as he was building that company. He didn't diversify well until he became a billionaire. Yeah. But all of his wealth was tied into one company. Steve Jobs with Apple, same way.
Example. Yeah.
Elon Musk with Tesla, same thing. And so he started building.
He made his money on PayPal.
Actually, he made his money on PayPal, but what he did was he took everything that he made on PayPal and then rolled it into Tesla.
Correct. Yeah.
And so he just kept doubling down and doubling down. And so it's a great way to accumulate wealth. You know what? It's also a great way. It's a very, very easy way to lose massive amounts of wealth when you're not diversified.
For every Steve Jobs and Elon Musk out there, there's somebody who bet it all on a company. Maybe, because they were the ones who built the company out, that the company failed. In fact, for every Steve Jobs, there are thousands who put everything into one company, and the company no longer exists. So, that's a great example. It's a great way to build wealth. It's also a great way to lose wealth.
It's a very, very easy way to lose wealth. And in the name of the game, once again, when you switch from that accumulation phase to the distribution phase, you're playing a different game.
Correct.
The game at that point becomes, how do we preserve what you have? Mm-hmm. How do we keep you from losing your money at that point? Because that's a far greater risk than you only getting 10% versus 15% in your portfolio, right? Yep. The extra 5%, and we've seen this time and time again with all of the clients that we work with, doesn't change your lifestyle at all. But if you lose 10 to 15%, that does change your lifestyle.
It changes in a big way.
Right? So we are far more concerned with wealth preservation than wealth accumulation. And that is why we build diversified portfolios.
Correct. And I go back on that point. What was rule number 1 again?
Don't lose money.
Don't lose money.
Yep.
So, all right. So let's talk about
going
back
to tax diversification, because you hear about diversification and everyone goes immediately to portfolio diversification, which is where you should go, right? That's where a lot of people go, and understandably so. And we just spent a lot of time talking about that. Not nearly enough time is spent talking about tax diversification. Tax diversification is understanding the way that different tax rates are applied to your portfolio in different ways.
Right.
Or basically, I should say, to different types of accounts.
There it is. And this is based on the accounts more than it is the investments themselves.
Correct. And notice that we're not going to talk about investments at all right now, because the way that taxes are applied to your portfolio, it's applied to the different types of accounts that you have, irregardless of the investments.
Right.
Doesn't matter. And I always use the cookie jar analogy.
Mm-hmm.
You can have 3 different cookie jars that have the exact same cookie. The only difference was when you take that cookie out of the cookie jar, how much of that cookie has been taken out of that first bite to taxes. Okay?
All right.
It could be the exact same cookie. You can have the exact same investments in different types of accounts. The difference is when you go to sell that investment, how much of that investment are you going to lose to taxes? Mm-hmm. Okay? So this is where we need to understand the different types of accounts that are out there and how they all play a different vital role in the in your portfolio construction, and how they're all valuable in different ways.
So before you go down that road, let's do a reminder. We've talked about this one before. We ask people all the time in workshops, things like that, what is the biggest expense in retirement? And it's not close. And almost all the time people will say healthcare. Mm-hmm. No, healthcare is a distant second. It's taxes. Taxes are your biggest expense. So mitigating that taxation is part of your strategy. And that's where you got to use the 3 types. So let's talk about the 3 types.
And this goes back to, what do you have more of when you go to retire than you've ever had before? Mm-hmm. You usually have more money than you've ever had before. If you've had more money than you've ever had before, you're going to pay more in taxes.
Right. And the government is the one thing that all governments excel at. I don't care who's in the White House. I don't care what country we're talking about. All governments excel at collecting what they believe is theirs.
And we're not going to turn this conversation into a conversation about the national debt and how it keeps. Everybody knows the debt keeps going up. Taxes are not going to go lower. We have the big beautiful bill that hasn't been passed yet, and they're talking about extending the current tax rates.
Right.
Notice they're not talking about cutting the current tax rates.
No, they're not.
Okay. There's no appetite anywhere to cut taxes, quite frankly. Right. Maybe at some states they're looking to reduce state taxes, state income taxes, Kentucky included, which is great, fantastic, wholly support it. But at the federal level, there's no desire to cut taxes. So all that to say, there's only one direction long term that taxes are going to go. They are not going to go any lower than they are currently. Right. They're only going to go up. They may stay the same, but they're definitely not going to go down. They're either going to stay the same or they're going to go up. So the different types of accounts that are out there and the different ways that they're taxed. And some of this might feel like, 101, financial planning 101. But
you know what? That's important because this is such a big deal.
But we have enough of these conversations to know that there's a lot of folks that don't truly understand the way that these different accounts work with one another. So it's important to review. Your typical 401ks, your IRAs, 403bs, 457s, they all work the exact same way. Keep in mind those numbers are not necessarily accounts. Those are just tax codes, IRS tax codes, meaning the way that those accounts get taxed is dictated by that code in the IRS, with the IRS. So those are all pre-tax accounts, most commonly associated with employer retirement plans. The money goes in pre-tax. Okay, so let's say you make $100,000 a year. You contribute $10,000 to your 401k at work. It went in pre-tax, so you don't pay taxes on the $10,000 that you contributed in the year that you contributed. Right. So you only pay
taxes on $90,000.
Exactly. So you're only paying taxes on the $90,000 worth of income. The $10,000 that you contributed to the 401k went in pre-tax. You have not paid any taxes, any income taxes on that yet. The money went into that account, and then it grows tax-deferred.
Right. There's the key phrase.
Meaning you don't pay any taxes on any of the gains until you take it out as income in retirement.
Right.
Okay? Pros. Very, very valuable from a tax planning perspective in that you don't pay taxes today.
Right.
That's fantastic, right?
These accounts get bigger faster, assuming the investments are the same in each of the different three types. This account will get bigger faster because all taxes are pushed to in arrears, if you will. It's on the back end is where you pay these.
Yeah.
That's probably the biggest pro.
So you're kind of turbo loading your contributions up front, which is fantastic. It's a fantastic benefit. The con is that it's all going to come out as taxable in retirement. And when I say taxable, there's different types of tax rates.
Yes.
Right? Yeah. And so this is going to be taxed at ordinary income tax rates. So when you look at, you Google federal tax brackets, whenever you Google a federal tax bracket, those are what your ordinary income tax rates are, and that's what those distributions from your 401ks, from your traditional IRAs, from your 403bs, from your 457s, from your TSPs if you're a military guy, right? Any of those more traditional qualified workplace retirement plans where money has been growing tax deferred, all of that income comes out as ordinary income in retirement. You will pay the full tax scale, basically the full tax rate on any of those distributions.
And one of the other cons that I would put into this is we know what our tax brackets are today. We know what they will be if the big, beautiful bill gets passed because they're already negotiating that one, which is basically to leave those brackets alone. What we don't know is what are the tax brackets going to look like in 2030? You will be in a different administration, and typically these change with each new administration, much less 2035 or 2040, which if you're retiring today, most likely you're going to still be alive and retired at that point in time. Your taxes are likely to be a different rate at some point in time in the future, and therein lays one of the cons of the tax-deferred style of investment.
But it is important to note that, because a lot of times this kind of is going to lean into the second one, which is tax-free, right? Which is basically anything with the word Roth in front of it, where the money goes in post-tax, meaning you've already paid taxes, income taxes on that, and the money you contribute to anything that has the word Roth in front of it.
Yeah, there it is.
Anything that goes into a Roth account has been contributed as after tax. So the money then grows not only tax deferred,
but
it comes out tax free
Right.
in retirement. So huge benefit. But a lot of people think that, oh, well, I need everything in a Roth. Well, yes, Roths are very valuable, and I certainly don't want to, downplay how important they are in a portfolio. But there's also a lot of value to a pre-tax contribution as well, because at some point in your life, you probably want to take advantage of, some or reduce your tax liability today. Right? You want some liability reduced today. You want some liability reduced tomorrow. You don't necessarily want to do all or nothing. Right? You don't want to reduce everything today so you have no reduced tax liability in the future, right? So you want to space it out because you want to enjoy the benefit, especially, let's say, in your 50s, where you're maybe closer to retirement. You're probably making more money than you've ever made. You're in a pretty high tax bracket. Well, let's mitigate some of those taxes to some degree, maybe, right? So there's benefit there. But there's also a lot of benefit to a Roth because that money obviously comes out tax-free in retirement, which is a huge benefit for a number of reasons. Number one, of course, obviously there's no income taxes that you have to pay.
Report it.
Tax-free. But we also talk about like the domino effect of taxes.
There it is. Yeah.
Right? And so the domino...
Social Security, go down that road.
Exactly. So Social Security and Medicare specifically. So whenever you start realizing more income in retirement, that not only affects your overall ordinary income tax bracket, but then it has an effect on how much in taxes you have to pay on Social Security and how much you might potentially have to pay in your Medicare premiums.
Right.
Because Medicare premiums for Part B and for Part D are income-based, meaning the more income that you realize that you have to pay taxes on, the higher your Medicare premiums are going to be.
So if you don't know, there's an additional tax once your income is over a certain rate and you're in retirement. You have an additional payment that you have to make on top of the normal Part B and Part D premiums on Medicare, right? And you're stuck with it. There's nothing that you can do. So that's what you're talking about, where your Medicare premiums can go up because your income went up. So I want to kind of pause. I had a client that I met with this week that had come to one of our workshops. And he had the whole concept of Roth. It was clear when he got there, it was really drilled into his head. Roth is good, right? Now, he had a unique situation, but in sitting there and talking to him, he really wanted to convert his 401k. It was a couple $300,000. He really wanted to convert that into a Roth. And the reason he wanted to convert it into a Roth is because he'd heard that when you take money out of a Roth, it's not taxable. So this all sounds fantastic, but he's not put it into a Roth to start with, right? All of this money is still tax due. So when you do that conversion, you're going to have to pay the tax bill on that. He wanted to convert the whole thing all at once, right? Which is like, okay, that's probably the worst possible thing that you could do here. But as we walked through it, once again, everybody's unique. In his unique situation, if we sequenced his Social Security and money that he was going to be receiving from a trust and his 401k, if we sequence them correctly, the Roth actually was going to harm him because he was going to have to pay so much to get the money into it, right? He was going to have an extremely small tax burden anyway if we sequenced it correctly. So this is where people get it in their heads. Roth is always good. No, it's a tool in the toolbox. And just like any other tool in the toolbox, used correctly, it's great. Used incorrectly, it's dangerous.
Mm-hmm. Or too much. I mean, not...
Or too much, right.
It's like if all you have is a hammer, everything's a nail, right?
Perfect example, right?
You're right. So we just want to make sure, we're diversifying the types of accounts that we have, because when you get into retirement, what I love is control. I love control, right? And so I love to be able to control my tax liability from year to year. Mm-hmm. Meaning, if I need to adjust one way or another, up or down, how much in taxes that I'm paying, or what my tax rate might be in any given year, I'm able to do that if I have a portfolio with all the different types of accounts that have all different types of tax liabilities. Because in some years, it might help me to pay maybe a little bit more in taxes from a long-term perspective, right? When we're doing a macro tax plan, right? When I say macro, I'm looking top down at all of the years in your retirement. I always talk about what a CPA's job is. The CPA has obviously a very, very, very important job. Do not misunderstand. I'm not downplaying CPAs, but their job is to limit your tax liability in the year that they're doing, the year that they're doing your taxes. Right? So if my CPA is doing my taxes for 2024, his job is to, find the way for me to pay the least amount of taxes in 2024. What we are doing from a macro tax planning perspective is we are looking at your overall retirement. And we're looking at how much can we pay in taxes throughout the course of your retirement, and the average retirement lasts 18 years, give or take. So if that's what the average retirement lasts, then we're looking from the top down. How can we limit your tax burden over that 18-year period? Sometimes that means front-loading taxes that you have to pay up front to reduce your tax liability at the end. Okay, so but all that to say, when we're building a diversified portfolio, we're not talking about the actual investments. We're not talking about the cookies in the cookie jar. We're talking about different types of cookie jars, meaning different types of accounts. So now we've got the traditional pre-tax account. Mm-hmm. We've got the tax-free Roth account.
And remember, we call those tax-free, but let's remember, only the growth is tax-free.
Exactly.
You still had to pay taxes on the first part. So there's a little bit of a misnomer there.
Correct. 100%. Great point. But now we get to the redheaded stepchild.
Yeah, there it is.
Right, the redheaded stepchild of cookie jars of accounts, if you will, is taxable accounts. Mm-hmm. And when I say taxable accounts, everyone, and I've seen this so many times when I talk about this with clients and prospects, they immediately recoil. Wait, you want me to put money in a taxable account?
No, I don't want to do that.
No, a taxable. Why would I want to pay taxes on an account? Well, it's because it's a different type of tax.
That's right.
Right? So we were talking about ordinary income tax rates. Well, this is a way for us to start to implement long-term capital gains tax rates and substitute long-term capital gains for ordinary income taxes.
Right. Now, let's make it very clear. Long-term and short-term capital gains are different. Your short-term capital gains rate, meaning you bought something and then you turned around and sold it for a profit in less than 1 year, is the same tax rate as your ordinary income effective bracket. That's not what you're talking about here. You're talking about long-term, meaning you bought it and you sold it more than 1 year later. Those rates are always lower than your ordinary income bracket. That's why that's important. So you're talking about, people bristle when they come in, they recoil. That's because they don't want to pay taxes, but you're going to pay taxes. But if you can pay them at a lower rate, that's how you win this game.
Mm-hmm. Yeah, and if you're able to couple long-term capital gains tax rates, remember the other thing with long-term capital gains tax rates is we don't pay a tax until we actually sell out of a position. So if you hold equities, and equities are growing, right? Because you only pay taxes on any income that comes in the form of like dividends or income or interest that comes in from bonds. So those will be taxed with short-term capital gains tax rates, a la ordinary income tax rates. But any type of equities or your risk on investments, if you will, your quote unquote market investments, if those are growing, any capital growth that you receive is not taxed until you actually sell out of that position. So if I own stock in Coca-Cola and I buy it 50 and that stock is now worth 100, I haven't paid taxes on any of that gain until I actually go to sell that stock.
Which means you control when the taxes are realized.
Exactly. So I have control over when I realize that gain. Now, I may elect to, depending upon the performance of the stock, right? I may elect to hold it for a little bit longer. Maybe I want to go ahead and sell. Maybe I even implement something called tax loss harvesting, where maybe my Coca-Cola stock that I bought at 50 is now worth 40. I can sell it at 40, and then I have a loss. But because it's in a taxable account, I can claim that loss on my taxes.
And it's a direct offset against your capital gains, by the way.
Exactly. And I cannot do that if that Coca-Cola stock is being held in a retirement, like an IRA or a 401k. I can't do that tax loss harvesting strategy unless it's specifically in a taxable account. So now I have all kinds of other different options that allow me to control the taxation of my overall retirement plan. So I love control. I love options. So anyone that comes in the door, I love to see kind of a three-legged stool, if you will.
I was hoping you would use this example because it's
Yeah.
a really good one.
Yeah. So, not to say that there's any such thing as a perfect portfolio by any means.
Doesn't exist.
That's not what I'm saying, right? And if you walk in the door with a $10 million 401k, are you going to run out of money? Yeah. No, probably not. Right? You're probably not going to run out of money.
Right.
But you know what you will have a lot of in retirement? Taxes. You're going to have probably a lot of money in taxes that you're going to have to pay. I love to see someone walk in the door, and we really don't see it much because we're still in the era of boomers that are retiring where they were really only contributing to 401k, and the conventional wisdom was max out your 401ks. So for the most part, most of what we see are going to be money coming in pre-tax accounts. Ideally, I love to see, and anytime that I can educate younger investors this way, you want to build up your traditional 401ks and your traditional IRAs, your Roth accounts, and your taxable accounts concurrently, right? You want to build them up in conjunction with one another. So if ideally you came in or you were to retire with a portfolio of a third, and a third, right? A third in each cookie jar, if you will. Mm-hmm. That's an ideally constructed portfolio. Notice I'm not talking about anything in regards to the investments themselves that are within the accounts. I'm talking about the accounts themselves because the types of accounts that you have are just as important as the types of investments that are within the accounts.
Correct. So your three-legged stool example, I like to take that one a little bit further. If you've got a three-legged stool and the legs are all the exact same length, which is what you're talking about, it's ideal. You've got that perfect thing to sit on. So if you've got one leg that is a little bit longer than the other ones, you're not going to fall off. I wouldn't set my glass of bourbon on it because it might fall off. But you'll be okay. But it's when one leg is dramatically longer, or God forbid, there's only two legs. Yeah. And now you're constantly balancing, trying to keep that stool up. That's kind of a good analogy for the way that your accounts work from a tax perspective in retirement. And that's the diversification that we're talking about.
We've got one of my favorite couples that we work with. Not that I have favorites, right? I love all of our clients, right? But I have a wonderful.
I have favorites. I'm going to go ahead and put that one out there.
There's a wonderful couple I work with. Wonderful people, fantastic. Just very, very nice. But we didn't bring them on board until they were in their early 70s. And what prompted them to come into the door was, I'm about to turn on my RMDs. Mm-hmm. I have to start taking distributions from my accounts, and I'm worried about all the taxes that I'm going to have to pay. It was a little bit of a reality check for them when I told them, and I was relatively honest about this, was, listen, all of your money is in pre-tax accounts. Or I think it was like 95% of all of their money was in pre-tax accounts. You're going to pay taxes.
The IRS is exceptional at getting what they think.
I don't care how many commercials you've seen on TV that talk about a tax-free retirement and all these things you hear on the radio. No, there's no such thing, right? You are going to pay taxes, and there's no way to avoid the taxes. We need to control it as best we possibly can, but because your cake has already been baked, right? There's not really much we can do from a tax perspective in order to, diversify your tax liability from year to year. You're going to have to pay your RMDs. You're going to have to receive your RMDs. You're going to have to pay taxes on your RMDs. There's not really much we can do about that. Now we set up qualified charitable distributions, and we're doing some other stuff, right?
I'm loving those.
So yeah, we are doing what we can, but outside of that, there's just not really much we can do to mitigate the tax burden. Mm-hmm. So it is what it is. I hate to use that phrase, but it kind of is what it is at that point. So that's why I say the things that they could have done 20 years ago to start to offset that tax liability in retirement would have been far greater, at 52 instead of 72.
So I think that's actually kind of a good point to start wrapping this conversation up a little bit. If you are already in your, say, 60s, right, you are either right at retirement or you're already there. The cake is baked. There's not a lot that we can do. To your point, you said it a minute ago, we can use some QCDs and things like that, that's a passion point for me. But you're going to pay their taxes. But if you're a little bit earlier, say 40s or 50s, where we are, this is a great time to begin to set up a tax diversification strategy for retirement so that you've got that three-legged stool, right? So that you have some options, so that we can adjust to the tax situation of whatever the day is and take advantage of that to the client's best.
For sure. That's probably a pretty good place
I
to
think
wrap
that's a
up.
good place to stop.
Diversify your taxes, diversify your portfolio.
There's so much to diversification, and we just touched the surface. We could keep going on for other types a little bit. I do want to wrap it up with something a little bit special. We talked about this last week. Last week when we recorded before you went on vacation, I've been holding down the fort all this week while Eric's been relaxing in wonderful weather. Last week was the 81st anniversary of D-Day. But tomorrow, today is, as we record this, is Friday the 13th, which in a bad luck family, this is our good luck day. That's our joke.
13 was my lucky number. You go back to all my childhood Little League photos.
I love Friday the 13th.
I had
right?
13. That was always my number.
Yep.
Yeah.
But that means that tomorrow is June 14th, and they have made a little bit of a news out of it this year. They don't talk about it normally. If you look at a calendar, it says it's Flag Day. But it's also Army birthday, right? And having been in the Army, this one's special to me. It's like a birthday to me. But this one's different because tomorrow is the 250th anniversary of the United States Army. So as we sign off, I'd like to have a toast to all my brothers and sisters who have ever worn that uniform. So
I will drink to that.
happy birthday.
All right. Thanks for joining us on the Retirement Planning Happy Hour.